Hi guys, and today we're talking about XP Factory, which is the company that owns Battle Boom Bars and Escape Hunt. I've been following this company for a number of years now. I invested, I think when it went to about 10p, sold when it went to 20 or 30, I can't remember. And I've been buying at various prices. But let's keep going because this is an annual review, annual report, if you like, for the year just gone by. And I think it's pretty exciting to be honest. I love the concepts of Battle Boom Bars. I think they're fantastic games and cool. It just looks amazing. So here's the highlights. Right, revenue's doubled, which is just pretty impressive. Like for like sales growth overall, 17% for Escape Hunt and 29% for Boom. EBITDA earnings have doubled, more than doubled, from 2.6 million to 5.5 million. Cash flow from operations has tripled. You don't get this very often, to be honest, folks. I don't know how long people have been investing, but this is quite rare, to be honest. I'll just move me a little bit over here. Operating profit, I don't know how you calculate that, from a loss of 5 million to a profit of 1.8 million. And they're growing their sites from 34 up to about 42. So growing about 10 a year. And then the franchise sites have gone from 39 to 33. So they must be shutting some franchise sites or maybe taking them over as owner operated. But this is pretty amazing. Let's dive into it. So throughout this deck, they talk about mature sites. So that's really important. The EBITDA at the site level is 42%. And the return on capital on net capex is 46%. Anyone that knows Peter Lynch says if you can find a company approaching 50% return on capital, invest everything in it. That's from his book, One Up on Wall Street, a investing classic. So owner-operated revenue's gone from 9 million to 28 million. A 30% like-for-like owner-operated sales growth versus 2022. Maybe this is because they've bought some of the franchise stores, maybe. Here you go, 5 franchisee acquisitions. So this is good. This means they can just buy up the franchisees if they need to, and maybe that increases their margins as well. So they're making some investments to further improve returns. So the revenue's gone from 4 million, 5 million roughly. And I think I invested in about 2020, 2021. That's when I invested. But I've been investing pretty consistently for the last few years. And revenue's gone to 44 million, which is 10x from 2019 in just 4 years. We've obviously had some a global thing happening in 2020, 2021, and 2022. EBITDA has gone from negative up to 5 million. It's gone infinite since 2021. It's doubled since 2022. This is pretty impressive stuff here. They're explaining the like-for-likes and the Battle Boom sites. It's a bit granular here, so we're not going to look too much at this. The site level economics are even more exciting. You can see it's going up. Mature EBITDA per room is getting higher. Year-on-year EBITDA for all cohorts is increasing. And you can see revenue per game for Escape Hunt is going up. The orange is the most recent year, right? Obviously, 2019 was a pandemic year. Sorry, 2020 and 2021, 22. Actually, it looks like they've removed those years, actually. My bad. The orange is the most recent 12 months, and the pink is the previous year. So it's up everywhere pretty much. The only one that looks like there's a fall is the Fourth Samurai. But anyway, these games are pretty good. So they're investing, and all the games seem to be pretty good. These original games continue to grow at these initial sites. So basically, people are coming back, most likely, and more people are coming. Additional games recently added, strong incremental return on capital employed, e.g. outdoor city hunts. I really like these next few slides. I think they're really indicative of such, why it's such a strong business. If you look at these sites and you look at the EBITDA, you could imagine that they're being built at different times. 20 sites were open in 2023. The first site is showing a 90% EBITDA to net capex ratio, whereas the newest sites are a bit smaller. So you imagine after a year, they're like, I assume they're paying themselves back. The weighted average for all 20 stores is 46%, which means, in my mind, once all stores have been open for a year, they're getting the money back. Might be not 100% accurate to that, but roughly, when a store's been open a year, it's returning everything back. That's what it looks like to me. That's what it looks like to me. Free cash flow typically higher than EBITDA, initially due to cash-free rent periods. So there's a little bit, it's probably not 100% return after a year because they get like a cash-free rent period from the landlords. But they're saying it's 46% weighted for the year. Now let's look at some for Battle Boom Bars. This was Escape Hunt. For Battle Boom Bars, it's even better. It's even bigger. 11 owner-operated sites opened in the year. 48% EBITDA return on capital. The first store made 190% return on capital. Crazy. You know, it is crazy. So it's even bigger. Free cash flow after initial build approximates to EBITDA across the site lifetime. So everything's in line with their expectations. So they're expecting about 50% return on capital. Like I said, Peter Lynch, if you don't know him, he's the most famous fund manager pretty much of all time. He worked for Fidelity with the Magellan Fund. Don't know how to pronounce it. But anyway, he made some great books. And one of the things he talked about in his books was high return on capital and good site level economics and brands that are going to roll out. You know, like he invested in hotels and Dunkin' Donuts and things like that. And that's where I really got the idea to invest in Domino's Pizza. And from there, obviously, Domino's Pizza went up 10, 20x in the UK. And I've stumbled across this site, this company, which reminded me of a successful rollout, you know, with high returns on capital. You know, revenues going up. Gross margins have gone from 52% to 58% in 1 year. You know, that's crazy. EBITDA margins of 18% for boom sites. Let's look at some of these. So revenue's gone doubled, which is good. There's some IFRS 16 adjustments. I'm not quite sure what those mean, but the adjusted EBITDA, it looks like there's an additional there. Is 8 versus 4, so adjusted EBITDA has doubled. We've got some depreciation and amortization. The pre-opening costs were much higher last year than this year, which is interesting. Maybe they open more stores. But the operating profit, yeah, has gone up to 1.8 and 1.5 after the fair value adjustment from 1.2. But overall, you know, looking at EBITDA, it's done very, very well. And yeah, I think the story's only going to get better. Look at cash flow, which is another factor. How much debt do they need to grow, or cash do they need to grow? You know, the cash conversion is immense. They produce 9.5 million, which is triple what they produced last year. Triple. That's like crazy. You know, for a small business, you know, I think it's only valued about 20 million, and it's produced 9 million in cash. That's yeah, that's pretty crazy. So they purchased more assets. Okay. The net increase in cash has been say 1 million, but it's gone from a loss of 5 million to a profit of 1.2 in cash conversion. The cash at the end of the period's gone up by over 1 million. It looks like, and 1.2 million it's gone up by, which is only going to help them to grow even further. They've got 2.2 million of additional funding. They haven't used all of it. They've got some loans, but it looks like, you know, it looks to me like they're easily going to be able to service those loans, to be honest. So I like this. Like, assets have increased pretty significantly. Property, plant, and equipment has gone from 12 million to 19 million. Right of use assets, I think that might be something. I'm not sure that's such great. I'm not sure what that is. It might be like the fact that they're putting the leases as an asset. So I'm not sure about the right of use assets, to be honest. Maybe that's also to do with some contracts with Disney, maybe, or some other brands when they're using for their games at Escape Hunt. I don't know. Intangible assets is something sometimes people use to fudge things. So they're not increasing this by very much. I think 1 million a year is very reasonable. Current asset stocks and is that work in progress? I'm not sure what WIP is in current assets. Anyway, it's insignificant. But cash has gone up and other receivables has gone up as well. Overall, assets have gone up by 9 million, which is good. driven by about 7 million in property, plant and equipment, which is the kind of the best line item if you like from all of this. It's the best one that you would want to go up because the others, look a little bit fudgeable if you like. So they have some liabilities. They've got the least liabilities with which is basically the cost of doing business. They've got like 7 million in other, which is a bit unusual. I'm not quite sure what 7 million of other current liabilities is, but nevertheless, the net assets is pretty high. 25 million. I think they're only valued at about 25 million at the time of filming. So it's crazy to have net assets like of 25. So the finance is quite interesting actually, like vendor and fit out finance and bank and other borrowings. They're all fueling the growth. So, with this much cash conversion, return on capital, I'm not worried about that in the slightest. So they're doing well in the first 10 weeks of 2024. So strong growth reflected in the like-for-life performance and site expansion, margins increasing, boom margins also doing very well, relentless focus on customer experience, etc. Blah blah blah. Growing opportunity in experiential leisure. So this is the juicy stuff. So yeah, fine. So the brand's amazing. Yes, something to be said for that. To be honest, high return on capital is improving. They're investing in data and system. They're leveraging synergies between the brands, and they're increasing the focus on B2B sales. I did note that when I booked an evening out with my colleagues from WhatsApp, they completely fucked it up, and they had some kind of PR event at the same time. And my American colleagues who'd flown over from California to be with us, we were kind of turfed out, which was a little bit crazy. But anyway, maybe they'll get better at the B2B side of things. Site expansion. They think there's enough for 150 stores in the UK. And there's even more international potential. I'm going to look at that later in the video to see how much potential there truly is. And I want to work with the right franchising partners. To be honest, the owner operated is working out pretty well anyway. So they're getting benefits from scale. They've got a capital efficient model with rapid payback and high return on investment. So it's an attractive organic growth thesis. They've got the industry leading unit economics. I can believe that. And it's improving, enhancing future returns. They're upgrading some games and widening food and harnessing data and using technology. They've got great review scores. Probably not needing to invest in marketing because I bet word of mouth is just like immense for these brands. So they're going to like optimize the layouts and things, with really high return on capital expected. They might even buy some more acquisitions, so both franchisee sites and maybe other brands as well, which could be interesting. So they're saying they're the leaders in competitive socializing, which is gaming, I guess. That's good. So they've got nearly 30 stores, and I guess escape rooms. We have or escape rooms rather, not locations, but they have lots of rooms. I suppose some of these brands may have more locations but less rooms, but nevertheless, they're a market leader already, even with just having whatever it is, 40 stores or whatever. I looked at this. I thought it was good that the ages. They're getting some people that are slightly older. I'm 39 at the time of filming, and I'm interested in going to Battle Boom Bars for my 40th. I think it looks really fun. I probably won't go. Who knows? But it does look fun. Probably have to go with maybe some younger folks, and it's a split over male and female as well. They got good reviews. Traveler's Choice. I thought it might be Trustpilot, which is the company I worked for at the time of filming, but who knows? Customer feedback looks pretty strong. They've got like some stuff on the property portfolio. They're pretty well spread. A lot of these opened fairly recently. So if we think about 2022 and 2023, there's well over 15 stores here that have been launched, in the most recent history. They've got 75 venues. There we go, 75 venues, 45 escape and 30 Battle Boom Bars. Fantastic. And they just look so much fun. I mean, look at that. It does look a lot of fun. Right. And the last thing is about, not the last thing, I'm going to look at some other stuff, but it's held by a lot of institutional investors for such a small company. You know, as I said, this is valued at like 20, 30 million. And you've got like a wealth management company owning 18%, another capital, I guess is that venture capital or trust, something like that, owning 13%. Another asset manager, Hargreaves Lansdown, which is the largest pension stockbroker in the country, in the UK at least, owns 7%. Stephen Lucas, I don't know who that is. Maybe that might be, is that someone in management? No, I'm not sure. Investor, maybe. Interactive Investor, another, you know, so that's probably retail investors, I imagine. Alliance Global Investors, another fund. John Edward Story, maybe an individual, and Hambro Capital Management. All of these are pretty serious companies or people, I would imagine, and you know they own a very large percentage here. It's well over 50% is owned by these serious investors, which suggests to me, you know, the stock price has been pretty awful, and we can take a look at it now. But I'm also going to do a forecast. You have to also think about, it's not just about stock price, because that's just looking at the past. You also have to think about the future. So I know the stock price has collapsed in recent years, but let's think about the potential for this brand. So it has collapsed from 150 when it IPO'd. So it's collapsed from like 150 when it IPO'd. I think I bought it in 2020 and sold it like 30, 40 or something. But then I've rebought kind of around the 30, 40 mark over the period of years. And I think I added again in 2023. Anyway, it's valued at 25 million. Now, remember, the net assets are 25 million. Even if you remove some of the intangible assets, let's say, you know, the actual real assets are like 10 million or like 90, you know, something like that, the net assets, it's still like ridiculous, you know, absolutely ridiculous how low this is valued. I'm going to do a forecast now and show what this could actually look like. So let's say that like they have 75 stores, right? They made 5.5. So each store is producing about 73,000 at the moment. Obviously, there's a blend of franchise and non-franchise, but they're not mature. It takes maybe a year or two to mature. So let's actually say that it's higher than that. It's 100,000 per store, which means when these 75 stores become mature, then earnings will obviously go up. Right, it doesn't like the there we go. Now they're growing by about 10 a year. But let's just be a little bit aggressive and let's say, actually, we'll do two forecasts. We'll do one for 10 stores a year and we'll do one for 20 stores a year. And for argument's sake, we'll just say at maturity. So I'm not going to say there's going to be 10 stores a year and they're all going to be mature earnings just to make it easier. So we'll say this is like 2024, 2025, 24, 2025, 2026. Right. I'm sure actually probably by later on they might be growing more. So let's say when they get to 100 stores, maybe they grow at like 20 a year, because that's definitely doable. And they did say that they wanted to get to 150 stores, so I do think that's sorry. So we're in 2024 now, so this is kind of a rough 10-year forecast that we'll do here. It's very, you know, off the back of a packet to a certain extent, but you know, I think that it's good to do this because you have to start somewhere when you're making investment decisions, and this is what I like to do, and this is just my process. You don't have to follow this process. And I'm actually going to assume that like this is going to be staying constant, that it's going to be 100,000 per store, for argument's sake. So we're at 2024 now. So when they get to 150 stores, I put 155 here, but they could be looking at 15 million pounds EBITDA. Now, if we just look at like a PE, price to earnings ratio valuation of 10 here, and we'll look at a PE ratio valuation of 20 here, and then a PE valuation ratio of 30. when I invested in Domino's Pizza, the PE actually went up to about 40 at its highest, maybe 45. So it's not kind of outside the realms of possibility that it could get to a PE of 30. Right, so what we'll do here is we'll times the EBITDA by 10. And you can see that when it gets to 100 to 15 million, the EBITDA at a PE of 10, the valuation goes to 155 million. Remember, it's valued at 25 million now. So that would be a pretty good return, like what is it, like 8x or something? Obviously, it's much greater when it has 20 PE. And I think if the return on capital is close to 50% a year, I would expect it to have a 20 to 30, maybe even 40 PE in the not too distant future, because not many companies can grow at 50% a year. And while they're small, I do believe they can, to be honest. I really do believe they will be able to grow pretty quickly. They only talked about 155 in the UK. They didn't talk, they didn't really give a forecast for the US or for other countries, to be honest. So it could easily be 500 stores in 10 years time. But let's use this for now. So in 6 years, 2030, we just look at that, that's 6 years away, and this is 10 years away. A 20 PE, a PE valuation of 20x earnings would give this a valuation of 350 million, which is pretty steep. It's like 15x or something. It's a lot. It's pretty good, to be honest. And a 30x valuation would be a 20x return from the current day valuation in 6 years. 20x would be pretty good, wouldn't it? And of course, if they do get to 255 stores, remember by this period, if they're only growing stores at 20 a year, that's quite a slow growth, to be honest. It's likely to be much higher than that, but let's use a conservative forecast for now, and we're saying it goes up 10 a year for the next kind of 4 years, which is very unlikely, and then 20 a year for the following 6 years. If there is a 30x PE, you're looking at a 30x return from 25 million to 765 million. Now I'm going to go with a slightly more aggressive approach here and say that the store count goes up a lot quicker from around 2027. And instead of 20 stores a year, it's like 30 stores a year. And we'll just do that across the board. And then from 2030, I think we'll do like, just assume that international is going well, and we'll do 50 a year. And we'll just say that's our bullish, that's our bullish forecast. And then on a 10 PE, 10 years from now, you're looking at about nearly 20x return for a PE of 20. You're looking at about 35x return, and if it has a growth PE of 30, then you're looking at an enormous return. It's about 50, I think 50x, is that 60x? I don't know. It's pretty enormous. Yes, that would be a 52x return. And the interesting thing is, with a lot of growth companies in the UK, like in the restaurant trade or whatever, retail stores, the owner operators often want to sell. Either they want to sell to a big player, or they want to just want to get out. They want to crystallize their earnings. But the interesting thing about this company is it's majority owned by funds and wealth managers and investors, which means there's a good chance that this is going to be a 10-year story from here. That's much more likely than when you invest in a small restaurant chain in the UK or a small retail chain. When they get to 100, 200 stores, they often want to sell. They just want to crystallize that growth. But this is very different. This, to me, looks like a rollout play that's funded and supported by the investment industry. They're talking about return on capital all throughout their deck. They're talking about payback periods and things like that straight off, all across their investor decks, which is good news. And it's approaching 50% return on capital, which is the highest I've seen since Domino's Pizza. And Domino's Pizza more than 10x'd. I invested in it, and from there I bought a house in East London with some of the earnings, but I didn't invest that much. I think I'm probably going to invest a bit more in this. I'm gonna kind of label this XP Factory PLC forecasts, and what I'm going to do is I'm actually going to share this in the description, and as like a view only access. Um, anyone with the link, so you'll be able to view it, and we'll be able to kind of look back in the future on, was I right, was I completely off? I think my thesis has been right since 2020 that this is a growth company. I invested when it was pre-profit, and when it was losing money. I thought it was going to be amazing, and it's already the industry leader in a lot of things in this kind of new competitive field. I think it's really interesting, it's fascinating. Hope you enjoy this video. Um, Obviously, I've got other videos on private equity, angel investing. I'm actually more bullish on this because I think it's very unlikely to go bust, and a lot of angel investments do go bust. Um, but this, has a chance to 50x. It really does, or 20x. And I think quite a strong chance, to be honest. This is the bullish forecast, if you like, bullish, and I'd call this one just like table stakes, to be honest. So yeah, I mean, it's not an easy journey investing in these small companies, and I'm not saying that the stock isn't going to go down, because if you think about it, currently it's valued at 25 million, but it's only made 5 million adjusted EBITDA. But if you look at the end result, it's only added 1.2 million to the bottom line. So someone might be thinking, well, that's only kind of, that's, it still looks expensive. But if you look at this story, them getting to 100 stores, which is like super likely, the EBITDA is likely to be, 10, 11 million by the year 2027. It could easily be valued at 200 million. That's nearly, that's nearly, a 10x return right there, in 3 years. So I think this is very likely. It's just my opinion, but I'm going to invest more in this. I love the company. The thesis is improving, and doing Facebook colors. I used to like doing things in Facebook colors. Anyway, despite how I was treated when they laid me off. I hope you've enjoyed this video. Like and subscribe. Remember that knowledge is power, especially the right kind of knowledge, and progress is everything. If you like this style of video where I analyze an annual report and do some forecasts, basic stuff here. I'm not a financial analyst working for Goldman or anything, but this is pretty logical stuff here. If you like it, let me know in the comments, because this is different from what I normally do. But I really hope you've enjoyed it, and I hope to see you in the next video. Remember that knowledge is power, especially the right kind of knowledge, and progress is everything. Take care.